All right, so another important concept to understand in making lots of money in crypto and understanding, the market cycles and price action, I guess you could say, is capturing the asymmetric opportunities. So I think in trading and investing in all markets, the goal is that you want to capture asymmetric opportunities. But I think in crypto, because of how much larger the risk is, I think you need a much more asymmetric upside to justify trying to make money in crypto. So yes, asymmetry in your investing is what you want in every asset class, but I think it's particularly important in crypto, okay? Because you get rug pulls, exchanges getting hacked, leverage trading getting liquidated. There's just so many things that can go wrong. There's a lot more downside, and it just becomes so much more important that you add asymmetry to your portfolio. And this is something that a lot of people fail to do. They don't actually have a strategy which is giving them asymmetric upside. And if your upside is not asymmetric, you're not going to get the returns of someone who does, which is what you're trying to make. So you're trying to make millions of dollars, cool. Well, you're going to need the upside to be very asymmetric. So let's talk about in this video how you can identify asymmetric opportunities. So the only way to make significant money in crypto is for your upside to be asymmetric. So just to visualize it, what do I mean? I keep saying this word asymmetric. Well, you have this much downside and a ton of upside, right? It's asymmetric. You take a little risk for a lot of reward, okay? That's how I would view it. So how do you bring asymmetry to your portfolio, to your process, to the strategy? Well, there's four main ways that I see from the perspective of, a long-term investor, but also a trader. So number one is you only buy and sell things when it hurts, right? So this relates back to the market cycle, which is what we talked about earlier, right? Crypto's price action is incredibly volatile, meaning that if you don't buy a coin during when it's incredibly fearful, you end up buying it at a very high price, you're going to lose a lot of money. So the goal to capture asymmetric returns is to buy your coins as close to the bottom as possible in order to have the least amount of downside and the most amount of upside. So in crypto, if you're buying your coins very late in the bull run, your downside is huge because the prices were only here 6 months ago. It's very likely that price goes back to old levels. And your upside is, still good, but it's similar to the downside. And you can see here that an entry here has an equal downside to its upside. That is not an asymmetric entry. So if you're trying to be a good long-term investor in crypto, the key is to enter as close as you can, time an entry at the bottom when the sentiment is anger or depression or capitulation, and that is where you get your entry for the bull run. Okay, so that's the long-term investor answer. And as well, there's another tweet here from Kun. Outsized performance, as in, asymmetric upside, comes from the shift from fear and unknown into the swing towards consensus, right? So you buy a coin when everyone says that the market's dying. You buy a coin when no one's talking about it, when people think it's dead. That's the best time to actually enter it, right? In that swing towards consensus, okay? So it's not just about buying when we're at the bottom of the market cycle. It's also about buying coins that are not being talked about a lot on Twitter. And I talk about in the final point here, you have to invest into coins before everyone is speaking about it everywhere online. So if you want an asymmetric upside, right, remember, markets are zero sum, so we're all just competing for the same money. If you have two rooms, right, people who have bought the coin that you own and people who haven't, right? Right, let's say people who own, right, your coin. People who don't, right? So let's draw a bunch more dots. So in this example, Not many people own the coin that you own, and a bunch of people don't own it, right? Now, in crypto, if you own a coin with $100 million market cap, and even if that coin goes to $1 billion market cap, crypto is $1 trillion asset class. There's still for every one person who owns this coin, there's still 100 people who don't own it. So I'm not saying that you're looking at how many own it versus don't own it. I'm more saying like how many own the coin and how many would buy it in the future, right? So the goal is that on Twitter, people are ideally, when you buy, not talking about your coin, and then later on everyone's talking about it, right? So for example, Toshi, I bought that at a $2.5 million market cap. I mention this a lot because it's just the most recent example. I buy it at a $2.5 million market cap, right? No one's talking about it. I'm the only dude talking about the thesis, right? So in this example, people who own the coin, there's like 4 dudes on this side, right? And people who don't, who will own it, it's like a fucking 100 people, right? That is asymmetric upside, because when no one is talking about the coin, when the sentiment is as low as it's going to go, right? The upside is asymmetric. Remember, I did a drawing recently showing you this, right? So this is the peak of the market and this is the bottom of the market, right? When you buy a coin when no one's talking about it, when everyone thinks it's shit, you're buying here. Now, when you buy here, your downside is capped to a little bit lower, but your upside is massive. So that's an asymmetric opportunity. Now, the more people are talking about the coin that you want to buy, the more confident you feel, the more it feels like it's the consensus that it's a good project, the later that you are buying into its cycle, and the more downside you present yourself. So when you buy the top, you have asymmetric downside, because you have obviously some upside. It could go higher, but it's also up 5x, and now it can have asymmetric downside, right? Asymmetric upside is a little bit of down for a lot of up. That's asymmetric upside, sorry. Asymmetric downside is a little bit of up for a lot of down, okay? You don't want that one. All right. Now, what's another way that you can add asymmetry? Well, when you trade, you place your stop loss and your take profit so that for every one that you risk, you win at least 3, right? Because if you, let's say your risk to reward is 1-to-1 and your win rate is 50%. So 50% of the time you win and you win 1, 50% of the time you lose and you lose 1. You end up not making any money at all or losing any money. So let's say for every 1 risk, you have 4 reward and you have a 50% win rate, you're now making money. Because every time you win 4, so it's 4, every 1 in every 2 times you win 4, 1 in every 2 times you lose 1. So you end up making money over time. So you add asymmetry to your portfolio through making the stop loss, take profit, and win rate profitable, essentially. Now, another way that you can add asymmetry is with your portfolio picks. So how many coins do you hold in your portfolio? If you hold, let's say, between 3 to 5 coins, you have not too little that you have a risk of ruin, but not too many that you can't get a good entry and exit by being scatterbrain, right? When you have too many coins, your attention is diluted, which means that you're not going to be able to have the focus and the time investment to get yourself a good entry. When I bought Toshi at $2.5 million market cap, it was the only coin in the entire market I was trying to buy. And that's why I got a good entry, because it was the only thing I was focusing on. If I had 10 other coins I had to look at, I wouldn't have bought the bottom. I would have got a way worse entry. I would have not had asymmetric upside, right? Let's look at Toshi right now. I want to show you this is a classic example. Right, this thing's up 20x. When I bought it, it was here. No one talked about it. Now everyone on Twitter is talking about it, right? If you buy it here, you have asymmetric upside. If you buy it here, you have asymmetric downside, okay? So what's the process for capturing asymmetric upside? First, you research. Then you find a coin you want to buy, and then you build thesis. then you don't buy once you like the coin. This is the biggest problem people make. They find a coin they like and they buy it immediately with no consideration of if the upside is asymmetric, right? This is a really important point to recognize. Most people buy a coin after finding it and determining it is good without any consideration for if the upside is asymmetric from the point of entry. Super important point right there. Okay? So that's step number one. Step number two is you wait to buy when there is fear amongst the holders and when crypto Twitter has forgotten about it, right? There shouldn't be anyone talking about it, or very minimal, and it should be, you know, a non-consensus bet, right? And this is what this guy talks about, Mikey, right? How does he make his money? How does he get asymmetry in his portfolio? He's made 2500x. Well, he finds, you know, he finds a coin with fundamental analysis, builds conviction, puts in size between a $5 to $100 million market cap, and he holds it for 2 years, right? That's how he gets asymmetry, which is much like what I teach in this program. Okay, so number three, after you bought during fear, you accumulate the core position, then you do nothing. Like what he says, you hold, you do nothing, sit on your hands for 2 years, right? And then you watch as your thesis doesn't play out, cut the position, or it plays out, sell at completion of the thesis, and then you find the next coin. So that is how you do asymmetric upside, how you implement from a process perspective asymmetric upside in your portfolio in the crypto market. Okay? All right, I'll see you guys in the next video.